We are midway through the month. Let's see how the calendars are faring this week with Bob Mason of FX Empire. This is the Midweek Wrap. Hello, Bob, and thank you once again for joining us today as we wrap up the week. Let's start with the major currency pairs as usual. Been a pretty quiet start to the week. Can we expect an upturn, and how do you see them faring for the rest of the week and going into next week?
Quiet start to the week for the US dollar, with the US markets closed on Monday. New York Empire State Manufacturing Index figures were out on Tuesday, and that was dollar positive. Some positive numbers on the economic calendar amidst a lot of red. So that suggests that Fed Chair Powell's outlook on policy and economic resilience is largely accurate for now. Looking ahead, we've got the Fed's minutes later on today, and then later on in the week, we've got Philly Fed's manufacturing index numbers on Thursday, which will be key. They have a greater influence on the dollar, and obviously then prelim February private sector PMI numbers, where focus will be on service sector activity. Dollar's found strong support this week. It's the combination of a resilient economy and positive economic data and market panic almost over the likely slowdown in China's economy that may drag through to the second quarter. It's a little bit optimistic to think that's going to just be a first quarter blip. Looking across to the euro, we had business sentiment figures, the ZEW numbers out at the beginning of the week. That was euro negative on Tuesday, and that combined with risk aversion that played the markets off the back of Apple's forecast warning on Monday that saw the euro slide on Tuesday as risk aversion hit. The market's got a wake-up call, really. Expectations were for fiscal policy and monetary policy to reverse any effects of the COVID-19. Really, though, however, that's quite a big call, and the doom and gloom may well go beyond the first quarter. So there are a number of issues to consider, and weak growth will continue, really, when we consider the stall in the German economy at the end of the fourth quarter. This week, we got the remainder of the week, we got consumer confidence figures out of Germany, and then the prelim February private sector PMI numbers, where we expect Germany's manufacturing and the Eurozone's composite to have the greatest influence in the week. Looking across to the pound, we had employment figures out at the start of the week. Those were better than expected. Claimant accounts rose less than had been anticipated, and the 3-month rolling employment numbers rose by far more than had been forecasted, supporting the hold at unemployment rate of 3.8%. Over the remainder of the week, inflation figures laid out today, and more importantly, retail sales figures tomorrow, that will need to be positive to remove market attention from the BOE and really hone in on Brexit and the negotiations on trade that are due to commence fairly shortly. At the early part of the week, we saw the pound take a hit. That was off the back of some strong arming from the French across La Manche, and David Frost responded in kind on Tuesday, talking of Britain's unwillingness to have strings attached, and that being completely pointless from a Brexit perspective. We remain tied into the euro. Yeah. So all in all, it's a busy week ahead. We had a quiet start, but there were some moves in the dollar, the euro, and the pound, with the dollar coming out on top.
It's been an even slower start of the week for the commodity currencies. Now, with the outbreak of the coronavirus really hitting hard on the Australian dollar and the Kiwi dollar, how do we see this improving possibly over the next week or so?
It's been a choppy start to the week for the commodity currencies. For the Aussie dollar, there were no economic stats until this morning's wage growth figures, leaving the Aussie dollar in the hands of the RBA on Tuesday. Dovish monetary policy meeting minutes for the 4th of February left the Aussie dollar on the back foot. The RBA statement on the 4th had shown little concern over the possible impact of the coronavirus. However, the minutes suggested otherwise, and members of the RBA had even considered a rate cut this time around. So that was negative for the Aussie dollar. Throw in Apple's forecast warnings and the risk aversion that played the markets on Tuesday, and the Aussie dollar took quite a hit. Wage growth figures this morning didn't impress. Tepid growth again. Quarter on quarter wage growth grew by 0.5%, which is the same rate as in the third quarter, and down from 0.6% in the second of last year. So wage growth remains an issue, and that supports the RBA's concerns over domestic consumption, household spending, which will leave the RBA on a defensive footing for now, particularly with, China's economy expected to be hit significantly by the COVID-19 spread. For the Kiwi dollar, there are no stats out, but with New Zealand's key export partner being China, obviously the doom and gloom lying ahead for China's economy and expected weak demand from China, that's left the Kiwi dollar on the back foot. China had accounted for 28% of New Zealand's exports the last time around. So that really does spell some trouble for the Kiwi dollar as well. So we may see both the RBA and RBNZ shift on their stances on policy. Whether we'll get an immediate rate cut remains to be seen, but we're definitely going to expect some dovish chatter. For the remainder of the week, we've got inflation figures due out of New Zealand that will provide some direction, though much of it will remain on sentiment towards growth. For the Aussie dollar, we've got employment figures, that last time around provided support. So any weak numbers, and expect the Aussie dollar to take another hit. We're already looking at sub 67s and sub 64s, so we could see further declines should sentiment deteriorate once more. Tomorrow we've got the PBOC loan rate cuts that are anticipated. That will provide some support, but ultimately the question is, will it be enough to provide support to the Chinese economy to really offset the impact of COVID-19? And the answer for that remains no for now.
And lastly, let's focus on the Asian giants, the Japanese yen and the Chinese yuan. Dire straits for both currencies at the moment and both economies. How do you see this planning out over the coming week? And can they improve and get some help somewhere along the line into the following week?
For the Japanese yen, it was quite a dire start to the week. We saw the Japanese economy contract by 1.6% in the fourth quarter of last year. That was far more than had been anticipated. Sales tax hikes, obviously the typhoons and the US-China trade war hit Japan economy quite hard. Then we turn to what lies ahead for the first quarter and quite like the second quarter. And things are not going to get much better with COVID-19 hitting the region. So there's not much left for the BOJ to hide behind. So they're going to need to make a move. Trade data today was not as bad as had been expected, but obviously a material widening in the trade deficit will raise some question marks over what lies ahead going into February and March, where we expect COVID-19 to really hit the Japanese economy and trade.
Excellent point.
Over the remainder of the week, we've got inflation figures at the end of the week. That's not going to do too much. So really, the yen's in the had a risk sentiment over the remainder of the week. We've seen support for the yen. Even with the dollar on the move, the yen's held steady at 109s. That's really due to its status as a safe haven. So expect more of that. Early this morning, on Wednesday, we've seen risk appetite return, but it's not a permanent thing, and that can change, really quite rapidly, as we saw on Tuesday. So for the yen, support will likely continue, but we're really expecting the Bank of Japan to begin to deliver on its promises to support the economy. For the Chinese yuan, there's been no data to consider, so it's really been in the hands of COVID-19 stats through the week. Obviously Tuesday's numbers and market reaction to Apple's forecast warnings, left the yuan on the back foot. That's even with the PBOC and the Chinese government delivering fiscal and monetary policy support. Tomorrow we got the PBOC back in action. We might see the yuan get some support later on in the week, but really it's down to market sentiment towards the economic outlook. And while the markets had expected growth to be hit just through the first quarter, we're rapidly coming to the end of February. So, the continued shutdown of factories and containment of the virus suggests that this is going to drag through the second quarter as well. So that's a lot of doom and gloom for the global trade environment and obviously the Chinese economy. So the yuan will be on the back foot for now.
Well, that's all for today. Thank you so much for joining us once again as we wrapped up the week, and we will see you again next time.